Hello everyone, welcome back to my channel. This time I'm going to make this is a different video from the previous ones that I've been doing, which is not about professional designations, self-guided tours and other stuff. And so I've been thinking about new ways of bringing content out to you. And I decided to create sort of a series to show you how you can use your financial expertise and your financial knowledge to your advantage. And so I decided, since I've been trading options for quite a while now on my own, I decided to create sort of a series in which I will show you what I'm going to do every week as I pursue my options strategy, and so to show you how can you make money over time in the market by trading options. And so this series is going to begin as a road to 200,000 euros, which is, I think, it's a fairly good objective. In my account currently there are about 100,000. I already have a few stocks here, and I still have a few options still live because of course this is the current state of my situation after the trading that I've been doing for some time. And so my objective is the objective of this series at this point is to reach the 200,000 euros net liquidity. Of course, I will be doing some deposits every once in a while because of course it makes sense. As you increase the amount of funds at your disposal, the more you can trade, the more profits you can bring in. And so this is something that it's going to accelerate our path towards the target. And so this is what we're going to do. Of course, as we reach the new objective, as I'm fairly sure that we will succeed over time, another milestone will come. I will think about it as at that point, but probably a road to, I don't know, 300,000 or 500,000, something like that. And so I'm going to explain to you the strategy that I use, which is quite well known, by the way, among options traders. And so this is a strategy that I am currently using. It's so-called the wheel strategy. To put it very briefly and to explain to you guys, for the people who are less aware of how options work, there are two types of options. So the call options allow the buyer of the option to buy the stock if the stock price ends up above the strike price, and so the call buyer will buy the stock at the strike price. If of course the stock price ends up by maturity above the strike price, but if the stock price ends up below the strike price, the call option will expire worthless, and so the call buyer will not exercise the option, and so the call seller will get the premium, which is the cost of the option. And so this is for calls. For puts, a put is a contract in which the buyer has the option to sell a stock at the agreed on strike price at maturity. And so if the stock price at maturity of the option ends up below the strike price, the put buyer will for sure exercise the option and will sell the stock at the strike price. But if the stock ends up above the strike price, the put option will expire worthless, and so the put seller will get the premium and nothing will happen. And so just to give you an example, if I have a stock which is currently has a price of currently 100, and I buy a call option on the stock and with a strike price of 110, if the stock goes all the way to 120, I can buy it for 110. So it's worthwhile to exercise the option and buy the option and buy the stock at 110 because it's valued at 120. But if the stock remains at 100, there's no sense for me to buy the stock at 110, and so I will not exercise the option. All right, that goes on the opposite way if it is a put option. If the stock is at 100 and I buy a put, for example, for 90 with a strike price of 90, if the stock falls down to, for example, 80, all right, I can exercise a put and sell my stock for 90, which makes sense because the stock currently is priced at 80. But if the stock remains at 100, it does not make any sense for me to sell it at 90. So I will not exercise the put. And so this is in a nutshell is what happens with options. And so the wheel strategy is a strategy in which I will start here at the beginning, at the top, by selling puts. So what happens is that I will sell a put, meaning I will commit to buy a stock from the put buyer if the stock price ends up below the strike of the put. So what happens is that I profit, well, first and foremost, because I'm selling a put, I receive a premium. And if the stock ends up above the strike price, it's good for me because I already have the premium. The option expires worthless, and so nothing will happen. The option will expire worthless. But if the stock price falls below the strike, the put buyer will exercise the option and will sell to me the stock, and I will be forced to buy it. All right. So immediately, if I sell a put, I will have in collateral the money, the funds, to buy the stock if the option is exercised by the put buyer. So in most cases, what will happen is that because I will sell puts with a strike below the current price, all right, most of the times the strategy will work out, and so the price of the stock will end up above the strike, and I will not have to buy anything, but I already collected the premium when I sold the option, so nothing will happen. I keep the premium for myself and the option expires worthless. But there will be times in which I will be forced to buy the stock because the price ends up below the strike. The price of the stock ends up below the strike. And so if the put expires worthless because the price of the stock ends up above the strike, all right, the trade is over. Next week I will sell another put, and I will continue to sell puts until the stock price ends up below the strike, and I'm forced to buy the stock. And so if I end up being assigned the stock, and so because I'm forced to buy it, what's going to happen is that I'm not going to sell more puts on that stock, and because I have the stock, I will sell calls on the stock. And so the collateral that I will be using is not funds, but the stock itself. And so I will sell calls, meaning I will promise that if the stock price ends up above my call strike price, I will sell my shares, the stock that I bought before, I will sell my shares at the strike price. And so most of the time what will happen is that the stock price will remain below the strike, and so the option expire worthless. I keep the premium from the calls. The premium is the cost, of course, of the option, and so nothing will happen. And so I will continue, while I have the stock, I will continue to sell calls and calls and calls until the stock price rises above the strike. And when that happens, I will sell the stock or the shares at the strike price, right? And I will get the money back. And so what will happen, all right, because the stocks were called away, all right, because I had to sell them, so I will come back, and again the wheel was completely turned, and I will again sell puts on the stock, and goes around indefinitely. And while I'm doing this, I'm selling puts, I'm selling calls, and back again selling puts and calls. And while I'm doing this, I keep collecting premiums, which is the cost of the option. And so I'm always getting money in, getting income from the trading, because I'm selling puts and I'm selling calls, and the put buyers and the call buyers are always paying me premiums at the start of the trade. And so this is my income strategy to keep gathering and earning more money by trading options. And so in a nutshell, this is a strategy. All right. At this point in time, as you can see, the strategy has been, this is a file that I've built for keep track of my trades. And so most of the time this has been winning trades. Of course, there are a few losses here and there, which is normal because sometimes the market goes against you, and sometimes these losses remain unrealized because I keep the stock until I'm able to sell it back. All right. And so when you get the stock is because you had a loss, all right, because you sold the puts, and so you bought the stock at the price above what they are selling for in the market, and so you have an unrealized loss. And so until you sell the shares back, you remain with unrealized loss, which you hopefully offset or can still have a capital gain if you sell those shares back by having assigned the calls back by the call buyer. And so I still, at this point, I still have a few stocks here which are mostly in the red. Of course, I can perhaps, yeah, I can refresh the page to show, yeah, these are in red because these are at a loss, which is normal, because what happens is that when you always, in order for you to buy the shares, that means you are incurring in a loss because you are paying more. The strike was above the stock price, and so that's why you bought the shares. All right. In some cases, like for example this one, the loss was significant because the price ended up by a large margin below the strike, and so in this case, of course, you will try your best to recoup the losses and still sell back the stock through selling calls. And so this is my current portfolio at the moment. I have shares in American Airlines, SLOD, Ford Motor Company, Hims and Hers, and Lyft. and I still have a few call options alive, calls on HIMS and calls on Lyft, which are yet live, haven't reached maturity yet. And so at this point we have about 49,000 euros in buying power. So this is money that is available to us to use as collateral to sell puts. All right, because if you sell puts, you need funds to use as collateral, because if you need to buy the stocks because the puts are exercised, you need to have the money to buy them. So this money is used as collateral, and so the stocks themselves are then used as collateral to sell the call options. All right, and so this is the way we are going to proceed. I have been proceeding with this strategy, and this is the way we are going to proceed from here on end, and this is what I will show you. In terms of the stocks that I selected, there are a few exceptions here. American Airlines is not with one that meets my criteria, or Lyft or HIMS, but of course these are a few experiments that I did. Some did well, some did not, went well, but for most of the time the stock selection that I will pursue is good quality stocks, all right, because you never know for how long you will be able to keep it if the puts are exercised, and so you'd better hold good quality stocks with of companies which are profitable, have positive cash flows, have a track record of profitability. They stay abreast of controversies and all that, and so this is something that is important to keep in mind. It's also good because you are selling options all the time. So for the people who are less aware of how options work, options are a play on volatility. So if you sell options, the best scenario for you is to have no volatility events in the market, and so the best way for you to continue with this strategy is to try to avoid as much as possible events on the company that will increase the volatility of the stock. For example, earnings announcements, earnings outlooks and all that. If you have upcoming earnings or other events that would spike volatility, it's good that you avoid those stocks for the time being. Wait until that event is over, and then you can sell puts or calls on that stock. So it's good to avoid volatility events. I usually try to sell options which expire in a week, because I believe those are the ones that have less uncertainty, because their time to maturity is shorter, and you get more returns annualized by having weekly options. And so I try to use weekly options as much as possible. Sometimes it's not possible because the premium is very low, and it makes it worthwhile sometimes to have a 2-week or 3-week option, but it really depends. But most of the time I will use weekly options as much as possible, and sometimes I will not let them expire at maturity. I will trade them before that, because, for example, if I sell a put option and the price and the stock rises up very, very, very quickly in the next few days, the price of the put option will go very, very close to zero, and so it does not make any sense for me to wait until the end of the maturity of the option to close it to let it expire. So because most of the profit has already been there for me to pick up, which means the price of the option is already close to zero, I will simply buy back the option at a near zero price, most likely 1 cent or 2 cents, I will close the trade immediately, which frees up collateral for me to sell other puts which may be more valuable at that particular point in time. And so it really depends. It really depends on what you on the trade. On the same page, for example, if you sell a call option and the price of the stock goes down by a lot, the value of the call option will go to near zero as well. So it makes sense for you to buy back the call and sell another call with a longer period of time for you to get more premium, because it doesn't make any sense if the price is already close to zero to wait until maturity to realize that that profit, the profit that you got from the premium. And so this is the way we are going to proceed. This is more or less in a nutshell the guidelines for me in the strategy that I use. Also in terms of the call options that I will be selling using these stocks as a collateral, most of the time I will try to sell them at the same price that I bought them, if not at the price above. Sometimes, because those, for example, in the case of American Airlines, I bought those stocks at 13.5 and 14, so probably those options with those strike price of 13.5 and 14 will not be available for short term options, for weekly options, because the price is already very low. So probably I will have to extend the maturity of the option or put a lower strike price, running the risk of having to realize a loss, but this is because you have to get some premium on the trade, and so to keep getting those premiums coming in. And so this is a decision that I will make on the spot, and I will explain to you as I go. And so this is it. I will try to post 2 videos per week. One after I put in the trades on Monday, because that's the first day of trading for the week that I usually start by selling the puts and selling the calls. And then I will make another video during the weekend, the next weekend, in which I will share with you the outcome of what happened during the week, which puts and calls expired worthless, whether there were any of those options which expired and I was assigned shares, or I had to sell shares of the stock. And so I will share with you those outcomes, and at the same time, of course, during that video on the weekend, I will update this sort of a scoreboard that I have in order for you to also keep track of what I'm doing and what were the outcomes, whether they were positive, whether they were negative. And so this is where we're going to proceed in order to get to 200,000 euros of net liquidity. And yeah, this is it. Let's hope that this works out well. As I said before, I've been doing this for a while. I think that most of the times it has been going well. As you can, even though this is not 100% accurate, because this calculation of being positive about 2,500 euros, it's not accurate because in the calculations here I used mark to market, and so when these losses, even though the gains that I had were all real because they were realized and they are set in stone and nothing can change them, the ones that are in the red, these are losses that happened at the time when the shares were assigned, and so these were based on the stock price when the shares were assigned. And so because the shares already have a different price, some of the trades, some of the calls, shares that I was assigned, I managed to successfully sell them back without having any capital gains or losses. I still managed to get a profit, because these profits were only from the premiums that I got, because I had no capital gains nor capital losses. For example, in this case, I sold, I had to buy 300 shares of APA at 29 euros, and so I managed on the next week to sell those same 300 APA shares at 29 again. So in terms of, for example, capital gains or losses, there were zero, because I managed to sell the shares back at the same price I bought them, but I still had a profit because I collected the premiums. And so this 2500 plus gain is not really accurate, because but this is something that I keep in here because I want to have more or less an estimate of how am I doing, what is the magnitude or an approximate magnitude of the gains that I've been having. And so this is something that I keep in mind. But of course, it's for me, what really matters is, of course, the gains, which are important to keep in mind. And also, when I get assigned, I pay the attention here to the values here on the side, because this is the gains or losses that I had when I close the wheel. Closing the wheel or turning the wheel is that when I get the full circle, when I manage to get to the end of the strategy, when I sell the shares back. All right, and so this is what really matters to me. And so even though in this case these are red, what happened is that when I managed to sell those shares back, I ended up making a profit because of the premiums that I collected. These ones, for example, are still in the red because I still keep these stocks, and so these stocks, because they are not yet sold, these losses are unrealized. All right. And so, but for example, in this case in here, because the option expired and I didn't get any stocks, this was actually a realized loss. I managed to lose 54 cents in here, and I had another trade here a little bit earlier, for example here, in which I closed the trade. But because the commissions were much higher than I expected, I ended up having a small loss, which was a realized loss. And so this was a real loss. But in this case, these losses are still unrealized. And so just for you to keep in mind, these are unrealized losses that I had. And these are the prices in which, a price per share in which I would break even if I managed to sell those shares at this price. All right, so this is a guideline for me to know where I should set up the strike price for the calls in order to break even. But this is just sort of a guideline. It really depends on the market conditions whether I'm going to follow this or not. So yeah, we will see what happens. Yeah, this is it. Feel free to leave your comments below, ask me any questions about how am I going to do this, yeah, make sure to like the video and subscribe, and I will see you soon with the next video showing you the trades that I will put in for the following week. So have a good week, guys. Thank you.